Speculation about the content of the budget is reaching fever pitch, and more companies are referencing it in their results and trading statements. Some of this may just be lobbying and advocacy, but it'll be interesting to see if many more chief executives express a view in the coming weeks' batch of results and updates. However, we must acknowledge that one set of figures may obscure all of the others, even though they will come from the other side of the Atlantic in the form of NVIDIA's third quarter results for the 3 months to the end of October. The shares have continued their meteoric rise, and the company's stock market capitalization hit $5 trillion in October, a figure which is the equivalent of the GDP of Germany and its 84 million inhabitants. NVIDIA's got 36,000 employees, by the way. Some questions are being asked about this valuation and how the spending spree on data centers, servers, and chipsets to develop artificial intelligence is being funded. So the timing of this quarterly update could not be better, especially as NVIDIA's boss Jensen Huang is publicly pushing back on the idea that a bubble's forming. NVIDIA's results are due on Wednesday the 19th, and they will be benchmarked against the guidance given by Jensen Huang alongside the second quarter results back in August, namely sales of around $54 billion, gross margin of around 73.5%, operating expenses of $5.9 billion, and a tax charge of around 16.5%. Add up all of those, and you get the current analyst consensus. Note that NVIDIA has a happy knack of not just beating the quarter's forecast, but raising guidance for the next one as well, so any outlook statement will be important too. So consensus is sales of $54.8 billion for the third quarter and $61.1 billion for the fourth. Net profit of $29 billion in this quarter and $33 billion in the next one. An earnings per share or EPS of $1.23 in the third quarter and $1.37 in the fourth, compared to 81 cents and 89 cents respectively 1 year ago. Now, tobacco's prospects look a little bit more prosaic than those of AI-related silicon chips, but shares in Imperial Brands are trading at an 8-year high all the same. This is thanks in part to the 5-year plan launched, implemented, and successfully completed by boss Stefan Bomhard, and he launched that plan back in 2020. Now, Mr. Bomhard retired this October, and Chief Financial Officer Lucas Paravicini took the helm, but not before he and his predecessor had outlined a second 5-year plan that's designed to keep cash and therefore dividends and buybacks flowing. After a mild profit warning alongside May's first half results, caused really by foreign currency movements, Imperial Brands stuck to its guidance when it released a full-year trading update in October, and it is still looking for the year just ended, low single-digit percentage sales growth, growth in adjusted operating profit to match last year's 5% increase, and a high single-digit percentage growth in earnings per share, all on a constant currency basis. When the company reports these full-year figures to September on Tuesday the 18th, analysts will therefore be looking for the following headlines, although any guidance for the year to September 2026 from Mr. Paravicini and new Chief Financial Officer Murray McGowan may be of greater importance. Anyway, consensus is sales of $8.2 billion on a stated basis, up from $8.15 billion a year ago, adjusted operating profit of $4 billion, up from $3.9 billion, and adjusted earnings per share of just under 314p a share, up from just under 301p. Watch out for any comments on volumes and pricing, as well as brand mix and growth in next-generation products such as Blue for vapor and Pulse for heated tobacco. Imperial Brands has been increasing prices and cutting costs to more than compensate for lower volumes, where stick equivalents are expected by analysts to drop again in each of 2025 and 2026. Any forward-looking statements, by the way, are likely to be measured against the new 5-year plan, where the goal is to generate high single-digit percentage earnings per share growth on an annual basis, with free cash flow of £2 to £3 billion a year, with the result that the FTSE Index member plans to increase its dividend and can also continue to buy back shares each year. And those cash returns will be the final area of focus. Imperial Brands has already flagged a fourth straight £1 billion plus share buyback in the year that's just begun. Analysts are looking for a dividend per share of 160.3p in the year just ended, and 173.7p a share in the year to September 2026. Those figures compare to 153.4p last time around. Add that to the targeted $1.45 billion buyback for the year coming up, and Imperial Brands is forecast to return some £2.8 billion to shareholders in the coming year, or some 11% of its stock market capitalization. Finally, we come to another FTSE 100 member, Halma, whose shares trade at all-time highs, having almost doubled from the late 2023 lows. The hazard detection and safety specialist is due to release first half results on Thursday the 20th. Chief Executive Mark Ronchetti increased guidance for revenue growth for the year to March 2026 alongside September's trading update to a low double-digit percentage increase, and he also steered operating margin forecasts to modestly above the midpoint of the company's target 19 to 23% range. A strong pound isn't helping on a stated basis, but analysts are looking for a solid set of headline numbers for these interim figures, namely sales up 11% to 1.2 billion, operating profit up 13% to 251 million for a 21% margin, and a dividend of 9.6p, up 7% on a year ago, and that would set the company on its way to a 47th straight year of increasing its payment by at least 5%. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.